Okay, in this video, we'll continue our discussion of identifying and assessing the risk of material misstatement. It's AUC section 26 of, or it's AUC section 315, understanding the entity and assessing the risk of material misstatement. So AUC section 26. And in this particular video, AUC section 26B. In the last video, we talked about financial statement level risks, identifying and assessing those. In this particular video, we'll talk about identifying the risk and assessing the risk of material misstatement at the relevant assertion level for classes of transactions, account balances, and disclosures. So let's go down to section A130 through A138 to get a little more details about how to go about this. Okay, so here we're diving into more details about assertion level risk. So first it explains the why that we need to do this, and it says we need to determine the relevant assertion level risk for classes of transactions, account balances, and disclosures. And we need to do that because it directly relates to, or directly assists us in determining the nature, time, and extent of further audit procedures at the assertion level that are necessary for us to do so that we can get a sufficient appropriate audit out of evidence. And it could certainly turn out to be the case that assertion level risk that we identified could actually turn out to be a pervasive risk across all of the financial statements. And in that case, the previous section of video would apply about financial statement level risks. But we still need to determine our assertion level risk. And we'll get into shortly what the assertion level risks are that we are assessing. So when management represents that the financial statements are in accordance with the applicable financial reporting framework, they're implicitly or explicitly making assertions regarding the recognition, measurement, presentation of the class of transaction events, account balances, and disclosures. So when they tell us that the financial statements are in accordance with their financial reporting framework, they are asserting to us all of these things. And it's our job to go in and determine whether that assertion is correct or not. And that's through further audit procedures that we will do. But first, we have to determine where are our risks that this assertion does not hold. And so here shortly, we're going to get into the specific assertions, but it says here that we can certainly name them differently, or we can choose to combine some. So that's all fine as long as we address each of them and determine the relevant ones. So assertions used by us in considering different types of potential misstatements may occur in the following categories. So we have three different categories, three main categories. So we have assertions about classes of transactions and events, and assertions about account balances, and assertions about disclosures. So typically I like to think about these as the assertions about classes of transactions and events would be more income statement assertions. For instance, revenue. And assertions about account balances at period end, this would be more balance sheet assertions. So for instance, accounts receivable. So although revenue and accounts receivable are somewhat related, in some cases we might test them differently or assess their risks differently by using these for the revenue and then these for the accounts receivable piece. And sometimes we might combine certain, for instance, classification and classification. Perhaps those are tested in the same or assessed in the same instance. Okay, so first let's look at the assertions about classes of transactions, events, and related disclosures for the period under audit. And so that would be occurrence, which would be that management has asserted that the transaction or event has actually occurred. So they recorded it, but did that transaction or event actually occur? And then on the flip side, completeness. So did management or the accounting group record all of the transactions and events that did occur during the year? So is that transaction journal complete? And so then accuracy would be for the transactions that the entity did record, were those transactions recorded accurately? And cutoff, did transactions events recorded in the correct accounting period? So did the transaction journal cut off at the right point? Classification, were they classified correctly? So were they recorded into the proper accounts? And then presentation, were they properly aggregated or disaggregated and clearly described in the related disclosures and in the financial statements? So these would be period transactions, more income statement related assertions. And now let's get down to the assertions about account balances, which would be more balance sheet assertions. So existence for the assets, liabilities, and equity. So do these assets actually exist? Do the liabilities actually exist? Do the equity interests actually exist? So if the entity has recorded a building on its books, does that building actually exist or not? So ways we might could further audit procedures that we might could do to look at that would be, go and look at the building. It exists or not. So and then rights and obligations would be, does the entity actually have the rights to the use or the ownership of that building? So these are two separate things. So is it real and does it exist? And then also, does the entity have the right to use and own it? And then next, completeness Does the balance sheet include all of the assets, liabilities, and equity that the company has control over or has an obligation to? Accuracy, valuation, allocation. And so for the accounts or assets and liabilities that the entity has recorded, were they recorded accurately in the right amounts? And then classification, were they put into the correct accounts? And presentation, were they presented correctly, either by disaggregating or aggregating them, or presenting them in the financial statements or the footnotes. So all of these are very important and very different, and we have to assess whether the client's assertions about each of these, if there's a risk that they might not be correct in the financial statement. And so assertions about other disclosures. So the assertions we just talked about can also be used by us when considering different types of potential misstatements that might occur in the disclosures that aren't directly related to the class of transactions, accounts, events, or account balances. So for example, such a disclosure might be the entity is required to describe its exposure to risks arising from financial instruments. And so the objectives, policies, and process for managing the risk and the methods used to measure the risk. So those might not be financial statement accounts or line items on the balance sheet or an income statement, but the entity still has to disclose those. So we have to assess the risk that they might not disclose them correctly. And next, we discuss a little bit about relevant assertions. So we've talked about the different assertions, but the only ones that we're required to assess the risk of would be the ones that are relevant. So we need to understand what relevant assertions are. So it says here that relevant assertions are assertions that have a reasonable possibility of containing a misstatement or misstatements that would cause the financial statements to be materially misstated, and as such are assertions that have a meaningful bearing on whether the account is fairly stated. So not all assertions pertaining to a particular account balance will always be relevant. For example, valuation might not be relevant to the cash account, unless there's some complication about the cash, for instance, currency translation. So there would be a risk of valuation there. But if it's in the reporting currency, the value of cash is the value of cash. So not really a relevant assertion there. Also, existence and completeness are always relevant because there's certainly always a chance that the assets recorded on the balance sheet are not or do not exist, or in the opposite direction, that the entity has not recorded all of the assets or liabilities on the balance sheet. So those are always relevant. Unless, of course, the entity recorded no assets, and so your risk would be that the assets are not complete, that perhaps they should have recorded assets, but existence is not at risk because there's nothing to, the entity has not asserted that anything exists. So for each class of transactions, significant class of transactions, account balance, and disclosure, that we determine the relevance of the assertions. Rather, we're required to determine the relevance of the assertions. So, and that would include determining the source of likely potential misstatements. And things we might consider might be the nature of the assertion, the volume of transactions or data related to the assertion, and the nature and complexity of the systems, including the IT. So certainly if there's a higher volume of transactions or data related to the assertion, then it might be more relevant. If the assertion is key to the company and its industry, it might be more relevant. And if determining the amount or the assertion is fairly complex, it might be more relevant as well. So it gives us a high-level understanding of the assertions and determining which ones are relevant. And in the next video, we'll discuss identifying the risks of material misstatement in those assertions.